Today, the RBA left its interest rates unchanged at a record low of 2.75%, with Governor Glenn Stevens saying although it has room to cut, it will wait. Joining me on the line is Athol Nourse, Global Head of Institutional Business at Synergy FX. Athol, why do you think Glenn Stevens is saying the RBA can cut rates, but not right now?
Well, from the RBA statement, it would seem that they believe the effects of last month's cut have not been fully felt yet. They are in a position now where growth is improving in some areas and the Aussie dollar has retreated into a more manageable level. However, should global economies stumble, the bank has the capacity to cut and stimulate our economy. The RBA will be keeping a close eye on China, whose recent data has been like a yo-yo, making it difficult to determine if its future growth can match expectation.
And is this a good move, and how will this impact the Aussie dollar?
Well, I believe today's decision was the correct one, as our economy has shown signs of improvement, and although the RBA clearly considered cutting rates again, I do believe there was not enough soft economic data to warrant such a move. Following the retreat of the Aussie dollar after last month's cut and signs of a recovery in consumer spending, I believe it was prudent of the RBA to adopt a wait-and-see approach. So the Aussie dollar actually fell slightly after the decision to keep rates on hold, even though I believe many traders would have been expecting it to rise, and I wouldn't be surprised to see the Aussie regain some ground over the next few days against the US dollar.
The Australian unemployment rate unexpectedly dropped to 5.5% in April as the economy added over 50,000 jobs. Do you think Australian unemployment will show a continued drop over the long term?
Well, last month's number was a big surprise, and in my opinion, the Australian unemployment will be heading upward in the short term. The labour market report has been bouncing around all over the place in the last 3 months. It was up 72,000 jobs in Feb, then we lost 31,000 in March, and as you mentioned, we were up then 50,000 jobs in April. So I'd be a bit cautious in interpreting these numbers, and personally I believe the underlying trend is still relatively soft. Job ads have been weaker in the past 2 months, and although employment is at near record lows, employee confidence in job security is also very low, with many Australians uneasy about the outlook for the job market.
And as we know, GDP currently stands at 3.1% and is predicted to show a decline to below 2% when data releases tomorrow. What are your forecasts, and how do you think this will impact the next RBA rate decision?
Well, we have had mixed data over the last few months, with poor business investment and softness in the housing construction sector, offset by a rise in exports and strong consumer spending. So I believe the good has outweighed the bad, even if only marginally, and I expect to see first quarter GDP growth of around about 0.8%, with 2.7% for the year to March, driven by strong consumer spending and supported by exports from the resources sector. GDP is one of the key indicators of economic health. So if tomorrow's data is above expectation, the chance of a rate cut in July will dramatically reduce. Having said that, if the data does show a decline to below 2%, I'd bet my house on a July rate cut.
That's all for now, but do check out my colleague Natalie McDonald's interview looking at coal. In the meantime, stay tuned to Dukascopy TV for the latest financial news and updates from the TV team. Bye for now.